Silver could reach $100 an ounce, and gold $6,000 an ounce faster than most investors expect, is no longer a fringe prediction rooted only in hyperinflationary fear or long-term monetary collapse theories. Rather, it is increasingly grounded in a convergence of structural forces in the global financial system, physical supply constraints, monetary policy realities, geopolitical fragmentation, and shifting investor psychology that together suggest precious metals may be repriced violently rather than gradually. And to understand why, one must first appreciate that gold and silver are not merely commodities, but monetary metals that sit at the intersection of trust, debt, and confidence in fiat systems. And when confidence erodes, repricing is nonlinear. At the core of this thesis is the unprecedented scale of global debt, which has reached levels that mathematically require either sustained negative real interest rates, outright default, or currency debasement to manage. And history shows that policymakers always choose debasement because it is politically easier and less immediately visible. As governments roll over trillions in debt at higher nominal rates, the interest expense alone becomes unpayable without central bank intervention, forcing monetary authorities back toward balance. Sheet expansion, yield curve control, or covert monetization, all of which are inherently bullish for gold and silver because they suppress real yields and signal to markets that fiat purchasing power will continue to erode. Real interest rates are the single most important driver of gold prices, and when inflation runs structurally above policy rates, as is increasingly likely due to deglobalization, reshoring, energy transition costs, and demographic pressures, gold's opportunity cost disappears, prompting both institutional and sovereign buyers to increase allocations far more aggressively than in past cycles. What makes this cycle different from previous ones is that central banks themselves have become net buyers of gold on a historic scale, particularly in the global south, as countries seek to diversify reserves away from the US, dollar in response to sanctions risk and geopolitical weaponization of the financial system. When nations that control trillions in reserves decide that gold is not just a hedge but a strategic necessity, demand becomes price insensitive, and this demand is occurring alongside declining mine supply growth, as new gold discoveries have fallen dramatically over the past 2 decades, and the average grade of mined ore continues to decline, meaning higher prices are required just to sustain current production levels. Silver's case is arguably even more explosive because it is both a monetary metal and a critical industrial input, and the world is entering a phase where silver demand from solar panels, electric vehicles, grid infrastructure, and electronics is colliding with chronic supply deficits. Unlike gold, most silver is produced as a byproduct of base metal mining, which means higher silver prices do not immediately incentivize higher production unless copper, lead, and zinc mining also expand, creating a structural inelasticity in supply that can lead to rapid price spikes when investment demand returns. For years, silver has been consumed in quantities greater than annual mine supply, with the difference made up by above-ground inventories that are now visibly declining. And once these inventories reach critically low levels, price becomes the only rationing mechanism, potentially driving silver far beyond what traditional valuation models would suggest in a very short time frame. Another accelerant is the extreme leverage embedded in paper precious metals markets, where futures and unallocated accounts represent claims on metal that exceed physical supply by multiples, creating a system that works only as long as most participants settle in cash rather than demand delivery. In a scenario where trust in counterparties erodes, or where large players seek physical possession rather than paper exposure, the resulting scramble for metal could force a repricing event similar to a short squeeze, particularly in silver, where the physical market is much smaller relative to paper claims. This risk is magnified by the broader fragility of the financial system, which is carrying unrealized losses in bonds and other assets that are highly sensitive to interest rate volatility. And, as seen in recent banking stress episodes, confidence can evaporate quickly, pushing investors toward assets without counterparty risk, a category in which physical gold and silver are uniquely positioned. Inflation itself is likely to remain more persistent than mainstream forecasts assume, not necessarily in a straight line, but in waves, as structural drivers such as aging populations, labor shortages, higher defense spending, climate-related disruptions, and the re-engineering of supply chains all raise the baseline cost structure of the global economy. Even if headline inflation temporarily falls, the credibility of central banks has been damaged by years of forecasting errors and policy reversals, making forward guidance less effective and increasing the appeal of hard assets as a form of insurance. Currency dynamics also play a critical role in the speed of potential price moves, because while gold is often discussed in dollar terms, its breakout often coincides with simultaneous weakness across multiple fiat currencies. And as confidence in sovereign debt sustainability wavers, competitive devaluations become more likely, effectively pushing gold higher in all currencies at once and reinforcing its role as a neutral reserve asset. If the dollar were to decline sharply due to twin deficits and political dysfunction, the dollar price of gold and silver could overshoot dramatically as global capital seeks refuge. Silver HRS historical tendency to lag gold early in bull markets and then dramatically outperform in later stages is another reason $100 silver may arrive sooner than expected. Because once gold decisively breaks previous highs and attracts mainstream attention, speculative capital often flows into silver due to its smaller market size and greater volatility, leading to percentage gains that far exceed those of gold. In past cycles, silver has reached multiples of its previous highs in relatively short periods, and when adjusted for today's monetary base and inflation metrics, a $100 price is not extreme but rather conservative relative to historical analogs. The psychological aspect of markets cannot be overstated, as investor sentiment toward precious metals has been suppressed for years by faith in central banks and enthusiasm for risk assets. But sentiment can flip rapidly when narratives change, particularly if equities and bonds struggle simultaneously, leaving investors with few traditional diversification options. In such an environment, even modest portfolio reallocations into gold and silver by pension funds, sovereign wealth funds, and retail investors could overwhelm available supply, given how underowned these metals currently are relative to financial assets. Technology and information flow also contribute to speed, as modern markets transmit fear and conviction instantly, enabling capital to move faster than in any previous precious metals bull market, while social media and alternative financial commentary amplify narratives around currency debasement, banking risk, and tangible wealth preservation, drawing new participants into the market who may prefer physical metal over paper proxies. Importantly, the notion that 6,000 gold or $100 silver requires a complete collapse of the monetary system is a misconception. Such prices can emerge simply from a repricing of gold relative to the size of global money supply, or from restoring gold's historical role as a meaningful percentage of financial assets. And when measured against metrics like global M2 or total debt, gold at $6,000 is not only plausible but arguably modest, especially if central banks continue to expand balance sheets to maintain system stability. Silver, when compared to gold via the gold to silver ratio, also appears historically undervalued. And a normalization of this ratio during a precious metals bull market could drive silver far higher, even if gold its move is orderly. The speed at which these levels could be reached is ultimately a function of confidence, and confidence tends to break suddenly rather than gradually, especially in highly leveraged systems. Once markets collectively realize that inflation is not transient, that debt cannot be normalized without monetary accommodation, and that political constraints limit fiscal discipline, the shift toward hard assets can become reflexive, feeding on itself as rising prices validate the thesis and attract more capital. In such a scenario, price targets that once seemed distant become milestones passed in months rather than decades, not because the metals themselves have changed, but because the measuring stick, fiat currency, has been quietly and persistently devalued. And when that reality is finally acknowledged by the majority, gold and silver do not creep higher. They reprice, and that repricing, driven by structural scarcity, monetary necessity, and human psychology, is why $100 silver and $6,000 gold may arrive